and welcome to the Morningstar series Ask the Expert. I'm Emma Wall and I'm joined today by Femi from Morningstar Investment Management to talk about emerging markets. Hi Femi.
Hi Emma.
So it's been quite an eventful year for emerging markets. I thought before we look forward we could perhaps recap over the last year. What has happened to emerging markets in 2018?
It's definitely been a very tough time for emerging markets. But before I think I would like to stress that there are two ways that investors typically get exposure to emerging markets. So there is the local currency side, which is bonds that are issued by governments within their own currencies, and then there is the hard currency debt, which is bonds that are issued by emerging markets, but then in foreign currencies. But whichever way you choose to look at it, it's definitely been a very tough year for emerging markets. So the local currency bonds have been down by 10% year to date, and the hard currency bonds have been down by 5% year to date, which compares with the global aggregate bonds, which is down by 1% year to date.
And what have been the drivers of those falls? Why have emerging market bonds done so badly this year?
So there are three main factors you can think of. The first one is the dollar story. So the dollar has actually been rallied by 4%. So in that environment, typically emerging markets tend to underperform. And then, compared with emerging market local currency basket, the dollar has actually been a bit rallied by 10%. So that's definitely been one driver. The second driver, you can also think about the current environment. It hasn't actually been favorable to trade. So investors are actually worried about the ramifications of the constant trade threats that you're getting from the US. The third factor is commodity rallies. So when you look at where oil prices are year to date, or compare with this time last year, oil has actually rallied by close to 50%. So when you combine these three main factors, it's actually exposed some vulnerabilities within some countries in the emerging market bond index. So countries like Turkey, Argentina, South Africa, and things like that.
It doesn't sound like a very positive position for emerging market bonds to be in. As you say, you've got strong dollar, you've got worries about the trade war, and you've also got the rising commodity prices. Do you think that these are enough reasons to be negative on the asset class? Or do you think there's a bit of kind of fear is overdone and they have slumped too much? Like, what position are we in now going forward?
So when you take the basket as a whole, so the typical basket that investors look at when they're thinking about emerging markets is the EMBI Global Diversified Bond Index. So when you look at that basket, there are a few countries there that are clearly, they're having issues. So the countries I mentioned just now, so Turkey, Argentina, and things like that. But it's much more than these countries. And those countries that I mentioned are actually a very small part of this index. So Turkey is only just about 3% of the Global Diversified Bond Index. And Argentina is actually even less than 1%. So even though Argentina has actually done minus 50% in USD terms year to date, it's actually the impact on the total index is relatively muted. So that's the first thing I would highlight. But the second thing is we have to think about the longer term fundamentals. So if you go back to 2013, where emerging markets are as of today, most of the countries within that index have actually improved their current account deficits. So except for these few countries like Turkey and Brazil and things like that. That's the first thing.
So fundamentals are strong? So
the fundamentals are strong. It doesn't actually, quite a few of the countries are improving their fundamentals, and the growth story is actually still there, which allows the countries to actually deleverage and improve their fiscal position over time. So we think that fundamentals are strong and they're getting better. So if you go back to where emerging markets are like 10 years ago, a lot of the countries are now comfortable to issue bonds in their own currencies, and the proportion of their total bond issuance within their local currency is actually getting bigger and bigger. So the fundamentals are strong, but there is the shorter-term impact of the headline news, and that's actually impacted. That's driven volatility year to date.
Femi, thank you very much.
Thanks a lot, Emma.
This is Emma Wall for Morningstar. Thank you for watching.